Hey guys, today I wanted to go over a really crucial topic when it comes to any kind of trading. This is something that a lot of professional traders don't really mention, but it's what makes them as successful as they are. Today we want to talk about risk management. We're going to go over how to manage your risk like a pro. So first we're going to talk about what risk management is, then we're going to talk about the cycle of risk management, how risk management affects your trades, and then we're going to talk about how you can effectively control that risk. So, first, let's figure out what I mean when I say risk management. When I say risk management in the trading world, we're referring to the process of identifying and analyzing your risk and either accepting that risk or mitigating it. We are essentially trying to quantify the potential loss of our trades. After we quantify our risk, we want to either accept it or mitigate it. Before I continue, I want to make it abundantly clear if you're sitting here right now thinking you're a good trader and you don't need to manage your risk, come back to me in a year when your account is at zero and we'll talk again. Risk is inseparable from return. When you purchase security in the stock market, crypto market, or any other financial market, you are accepting a certain amount of risk with that trade. So let's dip into the risk management cycle to get a good look at these steps involved in it. And this is how it helps us determine the actions required of us to properly manage that risk. The first step is to identify the risk. Usually, in this case, it's trading, so you risk losing money. The next part is to analyze that risk. What exactly causes the risk? Well, in most cases, it means that the trade didn't go the way you thought it would, and if it doesn't go the way you think it should, how much are you going to lose? The next part is to determine the potential for that risk to come into fruition. How likely is it that that trade isn't going to go well? And this is going to play into part of your solution. After this, you're going to examine some potential solutions. Maybe you need a stop loss. Maybe you shouldn't even be risking money on this trade, or maybe you need to wait for a better setup or a retest to occur. After you examine the solution, you're going to implement the best solution you can come up with, given the potential for the risk to happen and the implied loss from that risk. After that, you're going to sit back and monitor the results of that solution and refine it as needed for next time. So this is the complete cycle, and we say cycle because it's not a one and done thing. You don't get to call it a day after you've completed your risk management assessment and never look at it again. Risk management requires constant studying. It requires you to reassess the situation every time you trade, assess your losses, assess your wins, assess your potential gains and losses, assess your win rate, and even if it's at a satisfactory level, you can probably do more to achieve more. So let's look at how risk management can affect your trades. This is one of my trading logs, and this is from this month so far. Now, when you're looking at the running total, you can see where I went from $500 to just under 900K in less than 30 days. And this isn't because I'm an awesome trader. This doesn't mean I don't take losses. What this means is I have efficiently and effectively controlled my risk well enough that I don't need to be right all the time. To be honest, I have a very average win rate at best. I think this month I'm just over 70% win rate, which means I'm right about at that 2/3 mark most of the time. And you're probably looking at this log saying, man, you must have had some really big gains to win that kind of money. But the truth is, these small wins and even these small losses add up in a big way. As you can see in the last 2 trading days for me, my wins aren't huge. In fact, they're pretty mediocre at best. Some of them are actually tiny wins. But what you should notice isn't even really about the wins. It's more focused on the losers. How big are the wins and how big are the losers? The losses are a lot smaller. This is because I have very low risk tolerance for being wrong on trades. With my style of trading, I have accepted that 1/3 of the time I will be wrong about the direction a stock is headed, and the best way to make the losses almost meaningless is to cut them quickly so I don't lose too much capital. I identify there is a risk of potentially losing money. I analyzed that the risk was coming from me not being able to always determine the direction of the short-term price movement. I examined the potential risk by saying that 1/3 of the time I am wrong. My solution was to cut trades I wasn't confident in before the losses amounted to much. I monitored the results through my ledger and I refined it further and further until I could not find any other improvements on it. And that is the risk cycle. People who fail to follow the risk cycle and make the same mistakes over and over again are eventually blowing their account. The key thing to remember about the stock market, or any market really, is that the maximum adversary theory. The market will do what the market needs to do to ensure that 90% of the people who participate fail. That's how the 10% of us succeed. It's way more important to understand that you don't want to be that 90% because the 10 of us or the 10% of us will take your money and send you on your way. So the next part of risk management is actually you. You are the risk. You need to tell yourself that you need to be a good loser and not a bad loser. These are two distinct types of people that you can be a good loser. Someone who can accept that the trade was bad. Maybe their setup wasn't good. Maybe their position sizing was off. Maybe they failed to take profits at certain points or whatever the case may be. A good loser says, I could have done that better and I will do that better next time. A bad loser is the opposite. A bad loser is stubborn beyond belief. They refuse to make the changes to better their trades. They refuse to accept that they could have done something differently in order to achieve their goal, and they refuse to cut losers because they feel like the market will make a comeback, or they feel like the market owes them something because they've taken losses 3 times in a row, or 5 times, or 10 times, or 20 times, however many times they feel like they're due for a win. Unfortunately, I have news for you bad losers. The market doesn't owe you anything, and you'll likely keep losing until you accept that the market will do what it wants to do. And you need to change and adapt and grow with the market and figure out a way to be more profitable next time. The idea is that anyone can make a profit, and that makes you feel good. But if you can't take the losses properly, you will be in some serious trouble. So next, I want to go over the last important thought of the day for risk management before we dive into some examples of things we need to think about when it comes to risk management. This is called the risk of ruin, and it's about as scary as it sounds. Essentially, it's a mathematical equation that tells you if your plan itself is a success or not. This takes into account your potential win ratio, your risk-reward ratio, and sometimes can include your position sizing as well. Theoretically, you want your risk of ruin ratio to be at 0. You want no chance of blowing your account. But in practice, you essentially want it as low as humanly possible. So your risk reward ratio is how much risk you take in regards to how much you win. So if you risk 5 cents for a 5-cent reward, your risk reward ratio is 1-to-1. If your reward is 10 cents and your risk is 5 cents, it's a 2-to-1 ratio. As you can see on this chart, you need a certain percentage of wins to make sure that your risk of ruin is 0%. This, of course, is a theory, and since you will never be exactly a 1-to-1 or 2-to-1 or 3-to-1 all the time, your losses will vary and your wins will too. But you want to use this as a general guideline. If you can manage a 1-to-1 ratio with at least a 55% success rate, you'll be successful. 40% for 2-to-1, and so on. This theory does not account for brokerage fees, so you need to include those as well in your plan. But for example, I aim for a 2-to-1 ratio most of the time, and my win rate is usually between 60 to 70%, so my risk of ruin is 0%. So make sure you keep the risk of ruin in mind. So let's take a quick recap here of all we've talked about and add a few new ideas as well. Make sure you set stop losses. Stop losses are the best way to mitigate extreme risk, so set it and forget it. Don't move your stop loss down ever. Make sure you make a plan for your risk management. It's important to understand that with a solid plan in place, your chance for success increases by a huge amount. Stick to the plan. For God's sakes, people, I hear it every day. People saying the right thing but doing the wrong things. If you know what to do to be successful, just do it, guys. I just don't get it where I'll hear someone say, "Oh, I should have set a stop loss, but I didn't." Or "I should have stopped trading this morning, but I didn't." And then, you see them the next day and they do it again. If you know what you need to do to fix the problems, just do it. So the next thing is don't be a bad loser. Simple as that. Learn from your mistakes, adapt with the market, and so on. The market doesn't owe you anything. The sooner you realize that, the sooner you can begin to grow and be successful. Cut your losers, take your profits humbly, and move on. The market will do what the market wants to do. You can't control the market. You never will be able to. So learn to take control of the things in your power and mold those into a successful plan of action. Make sure your risk of ruin is 0% or as close to 0% as possible. And lastly, paper trade until you see success. I don't know how many people I've seen blow their accounts instead of practicing with paper money, and I just don't get it. If you can't make hypothetical money, you surely can't make real money. Why not play it safe and find out for yourself first if you can make it work or not, instead of risking your hard-earned money? All right, guys, that's it for today, so stay humble.